Welcome to our CFP exam prep session on Generation Skipping Transfer Tax, commonly known as GSTT. Today, we're diving deep into this complex but crucial topic that often appears on the CFP exam. Let me break this down in a way that will stick with you. The Generation Skipping Transfer Tax was created to prevent wealthy families from avoiding estate taxes by transferring assets directly to grandchildren or great-grandchildren. Think of it as the IRS's way of saying you can't skip paying taxes just by skipping a generation. The tax applies when property moves to someone who's 2 or more generations younger than the transferor. Let's understand the fundamental concept through a simple example. Imagine grandmother Sarah wants to transfer $2 million directly to her grandchild Emma, bypassing her own children. Without GSTT, Sarah could avoid one level of estate tax. That's exactly what the GSTT prevents by imposing an additional tax on top of any gift or estate tax that might apply. The GSTT rate is currently 40%, which matches the highest estate tax rate. But here's where candidates often get confused. There's an exemption amount that aligns with the estate tax exemption, which is adjusted annually for inflation. For 2023, this amount is $12.92 million per individual. Now, let's tackle the 3 types of generation skipping transfers that you absolutely must know for the exam. First, we have direct skips, which occur when property is transferred directly to a skip person, like a grandchild. Second, there are taxable terminations, which happen when property held in trust ends its term and passes to a skip person. Third, we have taxable distributions, which occur when income or principal from a trust is distributed to a skip person. A common mistake I see candidates make is confusing who qualifies as a skip person. Remember, a skip person isn't just grandchildren. It includes anyone unrelated to you who is more than 37.5 years younger than you. This is crucial because exam questions often try to trick you with age differences rather than family relationships. Another tricky area is understanding the GST exemption allocation rules. The law automatically allocates your GST exemption to direct skip transfers unless you elect otherwise. However, for transfers to trusts, you need to affirmatively allocate the exemption. This distinction frequently appears in exam questions. Here's a pro tip for the exam. When you see a question involving multiple generations and trusts, immediately start thinking about GSTT implications. Don't just focus on regular estate tax calculations. Many candidates lose points by forgetting to consider the GSTT layer. Let's talk about a key exception that often appears on the exam. The predeceased parent rule states that if a grandchild's parent, who is also the transferor's child, is deceased at the time of transfer, the grandchild moves up a generation for GSTT purposes. This means the transfer wouldn't be subject to GSTT. Finally, remember that GSTT planning often involves complex trust arrangements. Dynasty trusts, for example, are specifically designed to leverage the GST exemption and pass wealth down through multiple generations. Understanding how these trusts work in conjunction with GSTT is crucial for both the exam and real-world planning. When you're studying this topic, focus on understanding the mechanics rather than memorizing numbers. The exemption amounts change, but the principles remain the same. Practice calculating GSTT in scenarios involving both direct skips and trust distributions. This will help you tackle even the most complex exam questions with confidence.